Imagine being able to look at a stock chart and not just see random price movements, but actually understand the emotional battle happening between buyers and sellers in real time. That's exactly what candlestick patterns allow you to do. These patterns, which originated in Japan centuries ago for tracking rice prices, have become the global standard for reading price charts because they're incredibly effective at visualizing market psychology. When you see a candlestick pattern form, you're essentially seeing a snapshot of fear, greed, uncertainty, and conviction playing out in the financial markets. This is about memorizing dozens of complicated shapes. It's about understanding the story that just a few candles can tell. In this guide, we're going to move beyond the basic candlestick definition and dive into the most powerful and reliable patterns that can help you identify potential trend reversals and continuations, giving you a significant edge in your trading decisions. Before we can understand patterns, we need to be crystal clear on what a single candlestick is telling us. Each candle represents the trading action for a specific time frame. Whether that's 1 minute, 1 hour, or 1 day, the main part, called the real body, shows the distance between the opening price and the closing price. If the close is higher than the open, the body is typically green or white, representing a bullish period where buyers were in control. If the close is lower than the open, the body is red or black, showing a bearish period where sellers dominated. But the real magic is in the wicks, also called shadows. These thin lines above and below the body show the entire range of trading for that period. The top of the upper wick is the high, and the bottom of the lower wick is the low. A long lower wick on a green candle, for instance, tells a dramatic story. Sellers pushed the price down significantly during the period, but buyers fought back aggressively to close it near the high. That's a clear sign of buying pressure. Understanding this basic language is the key to interpreting everything that follows. Now let's talk about the patterns that signal a potential reversal, starting with some of the most powerful ones. The first is the doji. This is a candlestick where the open and close are at virtually the same price, creating a very small or non-existent body. It looks like a cross or a plus sign. The doji represents pure indecision in the market. It tells you that buyers and sellers fought to a standstill. While a single doji isn't a strong signal on its own, when it appears after a strong uptrend or downtrend, it can be a warning sign that the trend is losing momentum and a reversal might be coming. The next crucial reversal pattern is the hammer. This is a single candle pattern that forms after a downtrend. It has a small body at the top of the trading range and a long lower wick that is at least twice the length of the body. The story of the hammer is a classic capitulation. Sellers pushed the price dramatically lower during the session, but by the close, buyers have stormed in and pushed the price back up to near the opening level. It has a strong signal that the selling pressure may be exhausted and a bullish reversal could be beginning. For multi-candle reversal patterns, the engulfing pattern is one of the most reliable you'll find. There's a bullish engulfing pattern and a bearish engulfing pattern. The bullish engulfing pattern occurs during a downtrend. The first candle is a red candle, followed by a second, larger green candle whose body completely engulfs the body of the previous red candle. This pattern signifies a dramatic shift in momentum. The bears were in control on the first day, but the bulls came in with overwhelming force on the second day, erasing all of the prior day's losses and then some. It's a very strong buy signal. Conversely, the bearish engulfing pattern appears at the top of an uptrend. A small green candle is followed by a large red candle that completely engulfs it, signaling that the bulls have been overpowered by a new wave of selling pressure. Another powerful three-candle reversal pattern is the morning star and its opposite, the evening star. The morning star is a bullish reversal pattern that forms after a downtrend. The first candle is a long red candle, confirming the downtrend. The second candle is a small-bodied candle, like a doji or a spinning top, that gaps down from the first candle. This is the star, and it shows indecision. The third candle is a long green candle that closes well into the body of the first red candle. This three-part sequence represents a transition from selling pressure to indecision to new buying pressure. The evening star is the exact bearish opposite at the top of an uptrend. It's crucial to understand that candlestick patterns are not a magic bullet. They are probability tools, not guarantees. The biggest mistake beginners make is seeing a hammer pattern in isolation and immediately buying, without any context. The single most important factor in making candlestick patterns work for you is confirmation. You must wait for the next candle to close to confirm the pattern's signal. For a hammer, you would wait for the next candle to be a green candle that closes above the hammer's open. This confirms that the buyers have indeed taken control. Furthermore, the reliability of any pattern increases dramatically when it forms at a key technical level. A bullish engulfing pattern that appears right at a well-established support level is 100 times more significant than the same pattern appearing in the middle of nowhere on a chart. Always combine your candlestick analysis with other elements of technical analysis, like the overall trend and support and resistance levels we discussed in our previous video. This multi-layered approach is what separates successful traders from those who just see pretty shapes on a screen. Remember, this is educational content and not financial advice. Trading involves substantial risk and is not suitable for every investor. Please practice these patterns in a paper trading account and ensure you fully understand the risks before committing real capital. If this deep dive into market psychology was helpful, please support the channel by liking this video and subscribing for more content that helps you become a more disciplined trader. Now, I'm curious, what's the first candlestick pattern you're going to look for on your charts? Let me know in the comments below.